I'm Larry Ripka, CEO of the Valmark Financial Group. I'd like to comment on yet another sale of a U.S. life insurance company this week. On January 26th, Allstate announced the sale of the majority of its life insurance businesses to entities managed by Blackstone for $2.8 billion. Some points worth noting. The sale will impact almost 2 million Allstate life and annuity policyholders. The sale did not include Allstate's smaller New York regulated company with $5 billion of assets. In an investor briefing that was given today, the company indicated that this would be retained by Allstate, quote, until it can be sold or the risk otherwise transferred to a third party. The materials provided as part of this briefing showed higher levels of reserves for this New York entity. 3, the transaction is reported to reduce Allstate's GAAP reserves by $23 billion. And finally, Allstate will book a $3.1 billion loss on this sale. Put that in perspective, the sale was for $2.8 billion. 100% of the loss was attributable to the annuity business line, which the company discontinued sales of in 2014. One has to look at this latest transaction as additional evidence of the headwinds that the U.S. life and annuity industry is facing. Be it sales like this one or spin-offs of life companies like Met, GE, Voya, and now AIG, it's clear it's very tough to turn a profit in today's low bond yield environment. I believe that this task is even more challenging for publicly held companies like Allstate that have SEC reporting requirements. If low interest rates persist, the true nature of the reserves needed for these blocks of business can't be evaded under pending changes to GAAP accounting standards. 16 years ago, I co-authored an article in the Journal of Financial Services Professionals that discussed the reserves that would be needed for certain products if interest rate declined. I included data from a detailed study by Moody's and the Fitch rating agencies that at the time pointed to tens of billions of dollars of additional capital that would be needed to back these products. The day of reckoning for this capital has come and is evidenced by the sales prices at a loss and increased reserves that are needed at companies like GE to post for business written long ago. Colin Devine was at one time a sell-side analyst that I followed at Citigroup. He covered the life insurance industry, and he said about the business, pricing mistakes last forever. Allstate certainly is not alone in facing challenges for existing blocks of business. In fact, one might argue that they recognized these challenges early on when they sold Lincoln Benefit Life to private equity in 2014. In the last 12 years, I'm aware of only 3 sales involving U.S. life insurance companies where they sold for more than their book value. The rest have been sold at significant discounts. These low rates impact the reserves for every type of insurance company, be it a stock company, a mutual insurance company, or private equity owned. No company is immune to these pressures. I had reported in a previous post that some of the best capitalized U.S. life insurance companies have been able to raise money on very favorable firms. In fact, in the attached chart, I show how 10 companies have raised close to $20 billion in the last 12 months alone. This certainly is a sign of confidence by institutional investors about these companies. But for the companies who cannot raise capital on reasonable terms, I see 3 pathways. The first is to take a loss on the company like Allstate did and selling to Blackstone, who can raise the capital. The price earnings ratio looks a whole lot better if the E in the PE ratio or equity is 1/2 of what the buyer put in it. The second path is to sell these blocks of business to a buyer who doesn't have to deal with the SEC reporting requirements. They oftentimes create synthetic capital with financial engineering, or we may know it as captive reinsurance. This seems the strategy for many private equity-owned companies. After the acquisition, they run these companies on a much smaller capital base and extract income. The third option is to stumble along, sell off assets, squeeze policyholders, try to push products that don't require capital. This strategy also involves seeing falling ratings and products that transfer more risk to policyholders. At Valmark, we assist in helping professionals navigate this changing environment. There's never been a time where informed advice about insurance companies and products is more critical. We established our broker-dealer more than 25 years ago because we recognized it was essential for advisors to have access to best-in-class variable products from quality insurance companies. Today, there is compelling evidence that clients are better served by having the option of variable products. Increasingly, informed and independent insurance professionals are coming to the conclusion that separate account variable products offer the best combination of safety and upside for many of their clients. As the Allstate example illustrates, perhaps these variable products are the only sustainable alternative that keep the interests of policyholder and insurance company aligned for the long term. If you'd like to have a conversation on this topic and find out how we can better help you serve your clients, I'd be glad to schedule a one-on-one call. You can do that through Brandy at the email and the phone number listed on the screen here. At Valmark Financial, we bring the golden rule to life. Thanks for watching today.